It's a brand new year, and in this video, we are going to be talking about what's going on in the markets, the economy, and what to expect for 2025 all around as an investor. For those of you who don't know me, my name is Nikki Dunn. I am a registered investment advisor and certified financial planner, and I also am the author of the book, Do This With Your Money. What I'm going to do is just go through some data that's going to show us where we're at today, and then we can talk about what we can expect for 2025. Let's get into some market returns. 2024 was a really good year for market returns on the back of a prior year that was actually pretty good as well. The S&P 500's total return was 25%, the NASDAQ about the same, and the Russell 2000, which is focused on smaller corporations, small caps, that returned a surprising almost 12%, considering that small caps have this headwind right now with higher interest rates. Typically, they're going to be taking on more debt to fund operations, and higher interest rates hurt them. So with interest rates coming down in 2024, that led to some pretty good small cap performance. Let's turn to crypto. Crypto had a banger year. Bitcoin, which is the Mac Daddy cryptocurrency, the leader of the pack, if you will, returned 119% in 2024. These are massive returns. Bitcoin has always outperformed the other assets, but it just continues to dominate even to this day after, about a decade of performance. It continues to strongly outperform the other asset classes. However, with that strong outperformance, you're always going to get more volatility. So I popped this chart up in Y charts comparing the percentage from the highs that we've seen with Bitcoin versus the S&P 500. It's very, very clear. This is just the year for 2024's ups and downs. But we have seen a lot more volatility in Bitcoin over the S&P 500. That's kind of the nature of that higher return that you get with something like Bitcoin. You're going to get those bigger ups and downs and that bigger volatility. So you just have to accept that. And it's typically we call it a long duration asset, where you want to be holding something like Bitcoin for, a longer period of time to let that volatility kind of work for you over time so that you don't pull out of the market at the worst possible times. Now, large cap stocks, they have been winning over the past few years. 2023, 2024, they were the best performers. And just keep in mind that, we want to remember that there are times when large caps are not the baddest in the bunch. We have seen periods of time where small caps have been the top performers. Cash has been a top performer. Emerging markets, so international emerging markets, have been the top performer. So I just think it's good to remember, because right now everybody is large cap, big tech. And that's all that's kind of on our minds, because that's what's done well over the past few years. But we do have to remember that this chart represents the fact that there's always a different winner every single year, usually. Of course, we have periods where the same asset does well year after year, and that's kind of what we're seeing with large caps. Maybe that continues going forward, especially with AI. So I can see that happening for sure, but it's just a good reminder that different asset classes perform differently during different times. So this has not changed yet, but we could definitely see a few more years of large caps being the rulers of the roost, similarly to how we saw real estate perform extraordinarily well for many years in 2010 on. Okay, so it's time to dive into some data from JP Morgan. We're going to be looking at their guide to the markets, which gives us so much information, insights into the economy, stock market valuations, what companies are spending money on, AI, the labor market. We're going to be diving into the highlights that I pulled from this 71-page document. So let's get right to it. So we can't go further without discussing stock market valuations. So as of the end of 2024, our stock market valuation in relation to the S&P 500 valuation is still pretty high. Now, I would say when we're looking at, the averages, this 30-year average here. So the 30-year average is 16.9 PE ratio, price to earnings ratio. So if you don't know what that is, don't worry about it. Just know that you can clearly see that we are above the 30-year average in terms of valuation. And we are even pushing, kind of close to where we were in 2020, 2021, where we had that stock market boom, that kind of craze that was going on. Nobody was losing money, speculation all over the place. We are not that far off of that time. And we know that the stock market can only hold up like this if earnings can support it. So we're going to talk about that in a future slide, if earnings can support where we're at today and what we can think about it going forward. I would say the stock market is not cheap by any means, and we're not really seeing high value here. Now, the stock market is supported by earnings. So if corporations are having strong earnings growth, we can have these valuations be supported over time. And essentially, even if the market's expensive today, if the earnings continue to grow at these corporations, then we could continue to just kind of see the stock market hold at the level that it's at. And when I say stock market, I'm talking about the S&P 500. So when we look at the earnings that are expected to happen in 2025 and 2026, we're expected to see higher earnings growth, much higher earnings growth than we saw in 2024. So we haven't gotten Q4 earnings results yet, but this is basically an estimate of 9% earnings growth in 2024. Well, we're going to see 14% in 2025 anticipated. And in 2026, it's estimated that we're going to see double-digit earnings growth again. So it doesn't look like earnings growth is expected to slow anytime soon, which means that even though the stock market looks expensive today, we could kind of see a floor happening in the stock market over the next few years where we don't really see it go much lower unless something big happens to change the trajectory of these estimates. So essentially, we may see the stock market hold up even though it's expensive due to the fact that corporations are expected to continue to grow earnings over the next few years very handsomely. And you might be wondering why. Why are these corporations doing so well? And there are multiple reasons for that. We're going to dive into the economy and the consumer data shortly, so hang tight. Let's talk about market concentration. So we've got the S&P 500. The top 10 companies in the S&P 500 are going to be those large tech companies, your Googles, your Apples, your Nvidias. You get the idea. So essentially what we're looking at is this top right side of this slide. You can see that the top 10 stocks continue to be a larger and larger percentage of the S&P 500's market cap. This is actually quite stunning to see. The top 10 companies in the S&P are approaching 40% of the all market cap in the S&P 500. This is a big number, okay? And this is something to be, I would say, concerned about. I think that when we're investing in the S&P 500 or index funds, we're looking for diversification. And when we have a market that is so top heavy like this, it can fall pretty darn fast if things start to unravel fast and hard. So now the market's really kind of depending a lot on these top 10 companies for these good returns. There are benefits too, on the flip side, to this concentration, and it's essentially what we've been experiencing. The S&P 500 has had great returns because of those top 10 companies, and so it's been easy to make money. It's been nice. We haven't had to think about it too much, but that could turn at any time. So I think that there's just pros and cons to this. But if you want to take control over diversification and you want to not be so dependent on those top 10 companies, you can take matters into your own hands and, start to diversify out in other ways. Here's another way to represent what's going on with this concentration in big tech. The Magnificent Seven. It's not the top 10, but it's the top 7, essentially. This is the green line, and we can see that the returns of the Magnificent Seven have been way higher than the, overall returns, and the lower, basically excluding the Magnificent Seven, the rest of the companies in the S&P 500. You could see between the green line and the blue line, that's a pretty big delta between the two. The Magnificent Seven still very much outperformed all of the other stocks in the S&P 500 and contributed to 55% of the returns of the S&P 500. So this is what I was talking about in the prior slide, how you have this concentration risk, and if these top 10 stocks don't do well, they contribute so much to the returns that we could see a lot of volatility. Now, something that I was pleasantly surprised to see, and this kind of goes in line with where we're going from here and how to kind of view this expensive stock market. When we look at the right side of this screen, the percentage of unprofitable companies, fortunately, currently, there are a lot more profitable companies than there have been in prior crises. So the tech bubble, the financial crisis, COVID-19, you could see large caps. We had a lot more unprofitable companies during these times. Now, this is only 7% compared to 28% during the tech bubble. I think that this is kind of a sign of what's to come, is that I don't want to say this time is different, but this time is better in terms of the data. We have a lot less unprofitable companies out there that can kind of wreck things. So the overall health of our corporations seem to be better. There's also a lot more cash floating around there for a lot of these larger companies as well on their balance sheets. Let's talk about the consumer, because the consumer dictates spending and what happens in the economy. That dictates how earnings growth looks. Earnings growth dictates how corporations get valued, and if we're going to see high returns in the stock market, low returns in the stock market, flat returns, whatever. So we need the consumer to essentially hold up the economy. So let's dive into the data. The consumer balance sheet, we've got a lot of assets on consumer balance sheets versus liabilities. However, the very, very wealthy people are going to be benefiting the most from this. But I will say, I did see data from Bank of America, which is a bank that a lot of Americans, use. And I listened to the JP Morgan conference call as well. And it sounds like across the board, we are still seeing cash balances look pretty healthy. So I thought that was good, but that doesn't distract from the fact that we are seeing cracks in the consumer and cracks in the data that we need to be very mindful of. However, I don't know if it's enough to bring down the ship. I don't know if it's enough to sink the ship, so to speak, yet in terms of recession. So debt payments as a percentage of disposable personal income is something that I look at. I look at overall debt. I look at just consumer debt. And what we've been watching is to see if this is going to break back above to pre-pandemic levels. So far, household debt payments, it has not. We're still below pre-pandemic levels. Where the cracks are coming in is below that, the flows into early delinquencies. So basically the percentage of balance delinquent 30 days or more. Really, auto loans and credit cards, we have seen these break above pre-pandemic levels. So more people are having trouble paying their credit card debt. That's something that we need to continue to watch. Mortgages, student loans are being managed through the SAVE program and other programs for people. That doesn't seem to be as big of a concern as it was going into 2024. Mortgages, we may start to see more HELOCs. We may start to see more cash out refis. things like that, as people need that money to pay off their credit card debts, because a lot of wealth is held in homes, even, across income and wealth spectrums. So we are potentially going to see more of that if we already haven't. But the kicker is consumers continue to spend. They keep spending. We have moved from goods being all the rage in 2021 to services being all the rage to now we're seeing more of a balance currently of spending on goods and services. Personal savings has held up. It's actually gone up over the past few years, which is a good sign. So the average, we're still below average in terms of the personal savings rate, but we're starting to see a little bit more savings happening. The unemployment rate is still historically low. We actually saw it tick down in the last report. And so that really isn't too much of a concern. Even though we have seen a little bit more people file for unemployment claims, still historically low, numbers. Jobs reports look good. It's kind of hard to see a recession right now, to be honest. As much as I would love to see the stock market give us a bit more of a sell-off and give us more value, I don't know if I see a strong correction coming anytime soon. I think that the data is surprisingly good or good enough to where we could continue to see strength, and being an investor is going to continue to pay dividends. We're in this new paradigm, especially with technology increasing at a rapid pace. AI is on the scene. It's here. It's making big change in our world. There's cars out there without drivers in the cities. I'm seeing it around Austin. And so that's kind of exciting. And it's really hard to bet against tech right now, as tech has been a big driver of returns in the stock market. I think that it's going to continue to be that situation for years to come. And when that shifts, I don't know. So yes, I'm essentially saying that the stock market's expensive. However, I don't really foresee a big sell-off or correction right now based off of the data that I'm seeing, the economy, the expected earnings growth, the technology advancements. All of this is kind of leading to me having a hard time getting bearish. And trust me, I've tried. Now, the new administration coming in, of course, that could definitely shift the trajectory of where we're going. So we are in a wait and see pattern to see what happens with tariffs, to see what happens with tax reform. Are we going to see the tax cuts get extended? And I'm not just talking for corporations. I'm talking for all individuals across all tax brackets, believe it or not. So we really need to see if a lot of these big tax cuts are going to continue to be there for us or not. This is going to be very impactful for business owners, especially with things like the QBI deduction. I won't get into the nitty gritty. If you want regular updates and to be in the know about what's going on in the market, what's going on in the economy, be sure to check out our wealth building community. I'll put the details in the description below. We have an amazing set of mentors, an amazing community of investors. That's the place that you want to be if you want to learn how to be a better do-it-yourself investor. We'll see what 2025 brings. I'll be here for you every step of the way. If you like this video, please hit the like button, subscribe to my channel if you're not subscribed, and I'll see you next time.